Only two companies in the entire world have a higher credit rating than the US government, one of which we will be discussing today is the pharmaceutical giant Johnson & Johnson. The JNJ stock is down 3% since February 2023, at the time where the S&P 500 increased by 21%. The stock has been trading sideways for years, which raises an important question for investors. Does this underperformance signal a buying opportunity for one of the safest companies in the world, or is it actually a result of declining fundamentals? In this video, we will answer this question by analyzing the J&J stock, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, considering the risks associated with the company, deciding on an acceptable buy price, and I'll also share with you my strategy and what I've been doing with Johnson & Johnson in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia, where we discuss everything finance. I also want to share a friendly disclaimer. Please remember that this is not financial or investment advice, and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Founded in 1886, Johnson & Johnson is the second largest pharmaceutical company in the US and the third largest globally. Until recently, Johnson & Johnson was the largest and best diversified healthcare company around the world. However, as of 2023, they decided to spin off their consumer health business, which included famous brands like Tylenol, Listerine, and Neutrogena, into a separate company now called Kenvue. This decision was made so that the company can further streamline operations and focus on its higher growth segments. These are innovative medicine, which focuses on developing and producing pharmaceutical prescription drugs, and medtech, which involves the production of innovative medical devices. Despite the spin-off, Johnson & Johnson is still very well diversified. As you can see on the screen right now, none of the innovative medicine subsegments make up more than 33% of total sales, with immunology and oncology having the biggest share with 33 and 32% respectively. Likewise, Johnson & Johnson's medtech segment is also very well diversified, with each subsegment making up a maximum of 33% of the segment's total revenues. At the time of filming this video, Johnson & Johnson is a mega cap company with a market cap of $380 billion. It is trading at a price to earnings ratio of 11.7 and has a nice dividend yield of 3.02%. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Johnson & Johnson has significantly lagged the S&P, increasing 16% since February 2019, while the S&P increased 81%. Now, when comparing Johnson & Johnson's performance with its competitors, Eli Lilly, Merck, AbbVie, and Pfizer, over the last 5 years, we see somewhat mixed results. Eli Lilly, Merck, and AbbVie outperformed, increasing 502, 65, and 114% respectively, while Pfizer was the worst performer after Johnson & Johnson, with a 31% decrease in its share price since 2019. Moving on to Johnson & Johnson financial statements, you'll notice that there's a new column here called 2023 Preliminary, but it has incomplete data. So we'll skip it for now and come back to it later, and I'll make sure to explain why it's not fully populated yet. Revenues grew from $81.5 billion in 2018 to $98.7 billion in the trailing 12 months. That's a CAGR, or a compound annual growth rate, of 4.7%. Similarly, we see that net income increased from $15.3 billion in 2018 to $34.6 billion, which is a CAGR of 22%. Now, unlike revenues, which consistently increased year to year, net income experienced a couple drops in 2019 and 2022. However, it looks to have jumped back to all-time highs in the trailing 12 months. Now, before moving on to the balance sheet, let's discuss this 2023 preliminary column. There are two main things you should know. First of all, Johnson & Johnson has not released its 10K for fiscal year 2023 yet. They've only released some numbers in their Q4 presentation, thus the incomplete column. And for those who don't know, the 10K is a detailed annual report filed by all publicly traded companies as required by the US Securities and Exchange Commission. It provides comprehensive insights into a company's financial performance, operations, and risk factors. Second, and more importantly, you'll notice that revenues look to have decreased in 2023, which is not really the case. As we discussed earlier, Johnson & Johnson spun off its consumer health segment in 2023, therefore this $85.2 billion excludes any revenue generated by Kenvue products. On the other hand, all previous financial data include the revenues generated by Kenvue. So to have a fair comparison, we need to find out how much revenue the consumer health products generated in 2022. Well, there's good news. In their Q4 earnings presentation, Johnson & Johnson recast their 2022 statement of earnings to exclude Kenvue's share. As you can see here, without Kenvue's share, revenues would have been $80 billion in 2022. So this basically means that revenues actually increased in 2023 from $80 billion to $85.1 billion. Another thing to note from this report is net earnings from discontinued operations in 2023, which accounted for $21.8 billion. This refers to profits generated by parts of the company that were sold off or no longer in operation, which is in this case related to the spin-off of Kenvue. So Johnson & Johnson's total income in 2023 would be the addition of net earnings from discontinued and continued operations, which equals $35.2 billion. Now, coming back to the balance sheet, we see that the cash balance in 2018 was $19.7 billion and increased to $23.5 billion in the trailing 12 months, which is a CAGR of 4.4%. Current assets, which also includes the cash balance, increased from $46 billion to $53.7 billion, which is a CAGR of 3.8%. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, decreased from $10.8 billion in 2018 to $6.4 billion. That's a compounded decrease of 11.9% per year. So Johnson & Johnson is able to decrease its total debt in the double digits while still increasing its cash balance and current assets, which is really good to see. In terms of the dividend, Johnson & Johnson has a dividend safety score of 99 out of 100, which is the highest score possible. It gives the dividend a very safe rating and implies that a dividend cut is highly unlikely. It has an outstanding streak of paying dividends every single year for 108 years without a reduction, and has been increasing the dividend for the past 61 years, making it a dividend king. The dividend has been increasing on average 6% in the last 5 years and 8% in the last 20 years, with the latest increase coming at 5.3% in April 2023. As we can see here, Johnson & Johnson's dividend yield of 3% is higher than its 5-year average of 2.7%, which could possibly indicate undervaluation. Similarly, the forward PE ratio also indicates undervaluation, currently at 14.8 compared to its 5-year average of 16.4. However, as always, we do not look at any metrics in isolation and will only make conclusions by the end of the video. The earnings payout ratio is currently under 44%, which is lower than our preferred 60% threshold. We generally want it to be less than 60% as it gives the company space to continue increasing the dividend in the future. As you all know, I personally prefer to use the free cash flow payout ratio as the earnings payout ratio can be subject to accounting manipulation. Again, anything under 60% is our preference, and as we can see here, Johnson & Johnson's free cash flow payout ratio is currently higher than our threshold at 76%. However, it is expected to drop to 48% in 2024. Shares outstanding have decreased from 2.9 billion shares in 2014 to 2.6 billion shares today, meaning that Johnson & Johnson has been steadily buying back its own shares. We generally like to see declining shares as it signifies that our ownership stake in the company is getting bigger and the company's profits are being distributed on less and less shareholders. Now, coming to Johnson & Johnson's return on equity and return on invested capital, and just in case you don't remember, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. Generally, we like to see a minimum of 10% for both metrics, however the thresholds could change slightly depending on the industry. As you can see here, other than this drop in 2017, Johnson & Johnson's return on equity is generally in the low to mid-20s, averaging 21.7% since 2014, indicating a very strong moat. Similarly, the return on invested capital is consistently over 18%, averaging 21.1% over the 10-year period, which is really good to see. In terms of operating and free cash flow margins, Johnson & Johnson actually has very healthy margins. The operating margin has been comfortably surpassing our 12% threshold, averaging 26.5% since 2014. Likewise, the free cash flow margin is consistently over our 5% preferred threshold, averaging 20.2% over the 10-year period. As for net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, we generally like to see it under 3% for most companies, and it's currently under that threshold at 0.2. This basically means that it would take Johnson & Johnson less than 2 months to pay off all the company's debt with their net cash on hand. And yes, you heard me correctly. I said less than 2 months, not 2 years, which is really impressive. We see similar patterns for net debt to capital and interest coverage, with Johnson & Johnson comfortably surpassing our preferred thresholds with its considerably low debt levels, indicating a healthy balance sheet and a very safe dividend. One last thing to check before moving on to our valuation models is how did Johnson & Johnson perform in the last recession of 07-08, especially with the ongoing speculations of a recession in the near future. As we can see here, Johnson & Johnson actually increased the dividend during the recession. Their sales decreased by 6.2%, which is above average growth as most companies experienced a significant decline in sales. And finally, the stock declined by 27% during the recession, which comfortably beat the S&P 500, which declined by 55%. So just based on these numbers, Johnson & Johnson looks to be less susceptible to economic downturns than most companies, which is something worth considering if your base case scenario involves a recession in the next few years. Jumping into our valuation models, we'll be reviewing 4 distinct models to get to our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first model is the discounted free cash flow model, where we estimate Johnson & Johnson's intrinsic value based on the present value of their estimated future cash flows. We can see here the free cash flow that Johnson & Johnson generated over the last 10 years, growing at an average of 1.6% per year. Analysts are estimating future growth of 4.5%, reflecting their positive outlook for the company's future after Kenvue's spin-off. Using an 8% discount rate, which is also our desired rate of return, we get the present value of all future cash flow as well as our terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company in 10 years. Dividing the enterprise value by the total shares outstanding, we get a fair value of $140 per share, which is lower than the current price, indicating possible overvaluation. The second method is the multiples valuation model, where we obtain Johnson & Johnson's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating their average PE, and multiplying it by Johnson & Johnson's current earnings per share to get our fair value. However, before doing so, we need to decide on the EPS value that we will use. As we discussed earlier, Johnson & Johnson's 2023 earnings or net income were divided into 2 parts: earnings from continuing operations and earnings from discontinued operations, which had earnings of $5.2 and $8.52 respectively. Adding them together, we get Johnson & Johnson's total EPS for 2023, which was $13.72. Technically, the 13.72 is Johnson & Johnson's earnings per share. However, given that some of these earnings will not be part of Johnson & Johnson's future earnings, it doesn't necessarily make sense to base our future estimates on it. At the same time, we can't just exclude it entirely, because these discontinued earnings will still positively impact Johnson & Johnson's future operations, whether through reinvestment in research and development, stock buybacks, or possible acquisitions. So I think it makes sense taking a number in between. And rather than just taking the average or an arbitrary number, let me quickly show you Johnson & Johnson's EPS guidance for fiscal year 2024. As you can see on the screen right now, Johnson & Johnson is expecting an EPS of 10.55 on the low end and 10.75 on the high end. So to be conservative, let's just use the low end of that range in our analysis. So going back to our model, multiplying the average PE with 10.55, we get a fair value of 3,087, which is obviously ridiculous. This is because Johnson & Johnson's competitors currently have inflated PEs as a result of a decrease in their net income or a significant increase in their price. Even if we exclude the main outlier, which is Merck, from our analysis, we get a fair value of 886, which I still don't think is reasonable. So I believe it's best to eliminate this model from our analysis for now. I hope by now you are realizing why it's important to do your own analysis and have an understanding of how each model operates, as well as the significant impact that unreasonable inputs and assumptions could have on your intrinsic value. This is why I'd rather guide you through the process, showing you how I come up with certain values, rather than just giving you my final fair value. Moving on to our third method, the dividend discount model, where we estimate Johnson & Johnson's fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. We see here Johnson & Johnson's total dividend paid per share in the last 5 years, which grew on average 5.83% per year. Given Johnson & Johnson's dividend track record, I think they can definitely continue growing the dividend at that rate. So let's use a 5.75% growth rate for future dividends. Discounted at 8%, we get a fair value of $221 per share. The last method that we will review today is the historical multiples valuation model, where we estimate Johnson & Johnson's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PEs. As we can see here, Johnson & Johnson was trading at an average 16.9 PE during the last 5 years, 17.2 for the last 10 years, and 16.5 in the last 20 years. We calculate their average and multiply it by Johnson & Johnson's earnings per share to get our fair value of $178 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $180 per share, which is higher than the stock's current price and slightly higher than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With the 10% margin of safety, our acceptable buy price would be $162. Now, Johnson & Johnson is not a company without risks, and you definitely need to consider and evaluate these risks to determine your reasonable margin of safety before investing. So, to help with that, let's discuss some risks associated with Johnson & Johnson and its future outlook. I believe one of the main risks is the legal issues related to the ongoing opioid and talcum powder lawsuits. About 2 weeks ago, Johnson & Johnson announced the resolution of an opioid-related claim in Washington state. Johnson & Johnson agreed to pay nearly $150 million to resolve all pending opioid litigation by the state as well as the litigation brought forth by the U.S. State Attorney General. This comes after Washington decided to opt out of the $26 billion global settlement that was agreed in 2021. Now, just to be clear, this was a huge case that involved other major players like McKesson and Cardinal Health, so Johnson & Johnson is only responsible to pay part of that amount, which is said to be around $5 billion. As for the talcum powder lawsuits, last month, Johnson & Johnson reached a tentative agreement to pay $700 million to settle claims by over 40 states that it wrongfully marketed its talc-based baby powder. However, the settlement only addresses a small portion of the litigation. It does not resolve the personal injury lawsuits filed by over 52,000 plaintiffs in various US courts, alleging that the use of these powders, primarily Johnson's baby powder, caused cancer. Analysts have estimated that the ultimate settlement could range from $10 billion to $15 billion. It's also important to know that despite the Kenvue spin-off, Johnson & Johnson will retain all talc-related liabilities from litigation in the US and Canada. Kenvue will only be responsible for lawsuits outside of North America. Another risk is the ongoing attempts by the Biden administration to lower prescription drugs costs by giving Medicare the power to negotiate drug prices. Last August, the Department of Health and Human Services announced the first 10 drugs selected for Medicare drug price negotiation, 3 of which are owned by Johnson & Johnson. The negotiated prices won't take effect until 2026, and Johnson & Johnson, along with other pharmaceuticals, have already sued to block these price negotiations, which could possibly delay the start date even further. However, at this point, it's really impossible to estimate the potential impact that these price negotiations will have, but if it ends up going through, it will probably put pressure on the company's future margins. So with that in mind, you might want to consider a higher margin of safety when investing in Johnson & Johnson. For a 15% margin of safety, the acceptable buy price would be $153. If you're looking for a 20 margin of safety, your buy price would be $144, which is just under the stock's 52-week low. In terms of Wall Street's expectations for Johnson & Johnson stock, they're forecasting it to trade at $177 per share in 12 months, which is just under our estimated intrinsic value, implying a 12% potential upside from current levels. Now, I actually believe that Johnson & Johnson is one of the few companies that actually deserve a 10% margin of safety, and I do believe that the stock is currently undervalued. The risks that we discussed, although substantive, are not uncommon in the healthcare industry, and I believe that Johnson & Johnson will be able to deal with these risks and move on to greener pastures, as it always does. I do own the company, and it's actually the largest dividend stock in my portfolio, and the third largest overall. Now, I didn't buy it expecting crazy returns, but rather I bought it for its consistency. I see it as one of the most consistent and reliable companies in the world today. And given its AAA credit rating, it looks like credit rating agencies feel the same way. Let me know in the comments below your thoughts about the stock. Do you agree with Wall Street's price target and our intrinsic value? Do you believe Johnson & Johnson to be a strong buy today? Or do you believe the downside risks outweigh the potential upside return? Also, make sure to check our other stock analysis videos in which we analyze different investment opportunities in the current market and use the valuation models to determine their acceptable buy price. With that being said, don't forget to like and subscribe, and I'll see you in the next video.